it is proven that the best way to invest in the stock market is through diversified passive investing. It is a statistical approach of investing, and it makes sense. When we look at the World Price Index since 1969, we see some huge market crashes and sell-offs. The question is, are we strong enough to go through them and continue holding our position over time? The mathematics show that we must hold our position over time, even through big crashes. We are not robots. We should never underestimate such up and downs on our mind. Unless we invest and never look at it until we retire or take the money out, the ride can be very, very bumpy. What if there was a way to mitigate those big drops, even if it means lower returns overall? If such a method existed, it would provide a much easier ride. Looking at the Nasdaq, the same can be said. I am now going to show you a simple, effective way to filter the good and bad times. This is not a trading strategy. It is not meant to give higher returns. It probably won't, but it should effectively flatten the market sell-offs and crashes. There will always be market crashes and sell-offs. The only question is when and how bad. If you click the link in the description, you will be redirected to my website where you can download the free spreadsheet that I'm using. Market sell-offs occur because of fear. More and more people sell their position, making the price fall sharply and very quickly, which in turn generate more fear and more sales. On the contrary, when things are going normally, buyers and sellers keep exchanging trades, making the price move more smoothly. One way to identify extraordinary times is by looking at the volatility. Mechanically, the crazier times, the higher the volatility. In a sense, we then should stay clear of the market during abnormal volatility. This is the simple principle behind this filter. The blue line is the Nasdaq 100. The black line is the result of trying to avoid the biggest market sell-offs by following the filter. We can easily see how the black line is much smoother. This is so important as we all are humans and we cannot do without our emotions, especially fear, which is a huge driver in our reactions. Of course, this filter is not perfect and we will miss out on some times when the market goes up. But this is a very small price to pay to have our mind at peace. Although the calculations are not very complex, the spreadsheet does everything for you. The first thing we do is look at the price variation, the daily price volatility. This is this red dotted line. Just looking at the daily price change doesn't give a good indication. To make things more readable, we take a standard deviation over the last 14 days. This is the thick green line. To use this spreadsheet is very easy. We insert a new line above the orange line. We'll use Yahoo as the source of information. We just copy the last price data. Paste it there. And just extend the formulas. Now, what we want to look at is the standard deviation of the price change over the last 14 days and the threshold. For the Nasdaq 100, the threshold is 1.8%. If the standard deviation is under this threshold value, we are good. If it's equal or higher, it means it's possible that the market is starting to be a little bit crazy and we might be facing a sell-off. Of course, this filter is not 100% accurate, but what is important is to be out of the market when the big sell-off finally happens. In the results tab, we can look at a different range. For example, since 2010. Let's look at the internet bubble. Unfortunately, we missed this huge ramp up, but we missed also this huge sell-off. Overall, over enough time, we are very similar to the market without going through this very painful time. I did say that this is not a trading strategy and it's not meant to boost profits. But for those willing to try their luck, this is the chart of the 2 daily leverage Nasdaq 100 ETF. As you can see, over those 30 years, the increase of profits is massive. The reason behind this is that as the market goes down, leverage ETF are hugely impacted. Buying and holding the leverage ETF for the Nasdaq 100 meant that it took a very, very, very long time to be able to get back up from this huge sell-off. Just by avoiding it, the profits can continue to pile up over time rather than having to try to recoup losses. I wouldn't necessarily advise using this filter to trade, but there you go. To conclude, I would say that at the moment, looking at the volatility, I prefer to stay out of the market because I feel that it could go either way. Let's see what happens in the next few weeks, month. All in all, this is not the holy grail, and I guess nothing is, but this has definitely helped me sleep better. Thank you.